Very nice. I do have one question though. Is that bottle going to cost me 25% more after 4 o'clock today?
It certainly will, if not 50% more. Welcome to It Comes in Pints, a Seattle Study Club podcast where we will explore a myriad of topics: clinical, health and well-being, psychological, education, business, and much more. I'm your host, Greg Tice.
I'm Brian Bortz. I'm a partner at Kane Waters and Associates in Frisco, Texas.
Brian, welcome to the Seattle Study Club podcast, It Comes in Pints. As you know, as we discussed in advance, part of this podcast is introducing a drink from each of us for each episode. So I will start and share what I am drinking this afternoon. I am drinking a very special single malt Scotch or single malt whiskey from Canada. This was actually given to me. You could see how empty it almost is. It was given to me by one of our directors, Scott McLean, a number of years ago, and I'm still working through the bottle, but it's one of my favorites. And today I am drinking it neat, so no ice.
Very nice. I do have one question though. Is that bottle going to cost me 25% more after 4 o'clock today?
It certainly will, if not 50% more. If we're going
All right.
reciprocal tariffs, then it might be more than 25%. So
That's right. Well, to extend the same spirit, so to speak, I am drinking Eagle Rare. Eagle Rare is a wheated bourbon. It is my personal favorite, and I am drinking it with a small cube in there, if you can quite see it. But Eagle Rare is one of the bourbons out of Blanton's stable, and it is really, really easy drinking. So it's delicious.
oh, that would be dangerous for me. Dangerous for me. But we're doing this mostly because we want this to be sort of communal. We want this to be a relaxed conversation. So
Absolutely. Let me say before we get started, I'll give you my traditional toast. To the family you're born with, and to the family you make along the way. Here, here.
cheers. Oh, yeah, that's pretty good. I may have to have 2 or 3 more of those today. All right, so let's jump in, and I'm going to go right for the jugular, okay?
Sure.
So here's the question. I have liquidated all of my retirement funds. The 401k has been liquidated, the IRA has been liquidated, the Roths have been liquidated. Everything we've been invested in, because of everything that's happening, we have sold. We are now in cash. And the question I need you to answer, my wife and I are fighting over this. Do I take the cash and put it in the mattress, or do I put it in the barbecue?
Not the barbecue. Yeah, we actually do a monthly investment update here, and we just did that yesterday. And one of the things we covered was we've had more than a handful of clients call us and say, hey, with everything going on right now, should we just go to cash? What should we do? And my short answer is no, and we can expound on why. But the issue with being in cash for someone who is just retiring or in your case, just out of fear, is that you're never going to be able to keep up with inflation. So it's the one strategy that unless you oversave, won't work long term.
Yeah. And by the way, we really haven't sold everything. I listen to you guys. We're sitting and holding, so that's great, and we're diversified and all that, which we'll talk about all of those things.
Sure.
But it was the way I wanted to enter this conversation because there are people who are concerned. And let's start with a couple of those concerns, right? There's a lot of talk, a lot of news around the tariffs and reciprocal tariffs. Let's start there. Tell me how you guys at Kane Waters are thinking about this and the economy moving forward and how that affects investing and long-term savings, et cetera.
Sure. Yeah. Great question. Tariffs. It depends on what the purpose is here of these proposed tariffs. If the current administration is going to use them as a bargaining chip or a way to negotiate a better deal with other countries, then these things are going to be short-lived. That being said, it is being at least proposed and more than likely implemented with the intent that they're going to be there until we get a better deal. And the term that the current administration has used is reciprocal tariffs, meaning if you're doing this to us, we're going to do it to you. And that goes back to upsetting certain trade arrangements that we have that have been in existence since the end of World War II. Right. So you've got some really, really long-term relationships with some of our best friends in the world that are going to be really upset at us. And the logic behind it is, if it's okay for you to do to the U.S., then why isn't it okay for the U.S. to do to you? And hopefully the concept is opening other countries' eyes to the barriers of entry that they have for U.S. goods.
Right. So I know you guys don't have a crystal ball, so I'm not going to ask you to predict how long the tariffs will last or when those changes might happen. But assuming that not all countries and not everybody's going to respond the same way, what do you see in the short to medium term that doing to the economy?
Yeah, I think the very first thing that you'll hear, and if you watch any of the morning news shows this morning and tomorrow morning, you will hear prices going up. And that's the one thing that the Federal Reserve is nervous about, because an increase in price sure sounds a lot like inflation. This is not inflation. Do not mix the two. Prices will go up, but it is not inflation.
So what is it if it's not inflation?
So it is literally an increase in the supply chain of all the different parts and pieces that are made to make your widget, whatever that widget is. And by the increase in the supply chain, those increased costs will then trickle down to each supplier and ultimately trickle down to the ultimate consumer or purchaser of that product. So prices will go up in the short term.
Yeah. So from a consumer standpoint, and it's actually a nice segue, because consumer confidence is at one of its lowest levels in, I think, 5 or 7 years was the last number I heard. Does that affect the outlook as well?
I think part of the reason that you have such low consumer confidence, and to answer your question, yes, that does have an effect. But I think the reason you have that exists really is because of uncertainty. If there's one definition in the world that the stock market hates, it's uncertainty. And you have not only the uncertainty of whether or not we're going to have tariffs or not, it's the uncertainty of what those tariffs are going to be, when they're going to be implemented, how quickly are they going to be lifted or extended, what is the ramifications of a quote unquote trade war. You know, you're going to have all of these different things the market doesn't have answers to, suppliers don't have answers to, and ultimately consumers don't have answers to. So what do you do? Let me ask you a personal question. What do you do, Greg, when you don't know what the price of something's going to be?
Typically, I don't buy it.
Right. Exactly right. If you were in the market, you know, I'm thinking about, my son is about to graduate from college. I'm thinking about, for a very nice graduation gift, buying him a new vehicle. Well, if I wait and do that at some point,
I hear Teslas are going to be cheap.
Yeah, that's what, if they are still around. Yeah. But the funny thing is, if I wait and buy that after there is no such thing as a 100% U.S. made vehicle.
Right.
There's 30,000 parts in an average vehicle, and many of those parts are made all over the world. And so each of those parts are going to have a ramification on the ultimate cost of that vehicle. So I don't know what that's going to be. So if I don't know what that's going to be, maybe I don't buy it right now.
Yeah. Okay. So doom and gloom, right? We've been talking about that a little bit. There's uncertainty. There are tariffs coming in. It could be short term. It could be medium term, affecting the economy. What are you recommending people do right now with their portfolios? I want to start with if they have an existing portfolio, but let's also talk about some of the dentists that are just getting out of school now, right? Yeah. And do they start a portfolio? Do they wait, right? Because you come back to and again, I don't want to steal your thunder, but you come back to the articles I've read that say there in the last 50 years, there were, 15 or 20 days in the market that if you missed those growth days,
Yeah.
Your portfolio actually was underwater, but if you just stayed in the market, you were way, way, way ahead.
Yeah, it's funny. There's a reason that things become cliche because there's a little bit of truth to every cliche, right? And the old cliche in the investment world is it's not about timing the market, it's about time in the market. And really, if I was a young person in my 20s, we have this concept at Kane Waters we talk about how money grows. And it is the compounding effect of money. And we talk about a concept called 1-to-1, 2-to-1, 3-to-1, where money grows geometrically over time. And the compounding effect matters the most. But you can't start compounding until you start having a pile. Right. And so I would tell any young investor right now, if you're in your 20s or 30s and you're starting a systematic investment approach for savings and for your future retirement or for any project, start now. Don't worry about the short-term ramifications of what the market is, because there's only three things that affect the growth of your money. It's the amount that you save, the time that you have to save it, and the return that you get. And everybody wants to worry about the return, but the return doesn't matter until your pile's big enough. So just get that pile going. Get into that systematic habit of saving.
So that's for the young folks. Now
Right.
look at the gray hair on my head. For the people that, and I'm not retiring anytime soon, but that are up in their years and are on a shorter horizon from a risk standpoint, say from investing, what are you recommending there? Again, is it sit and wait? Does it depend on the horizon? What are you guys?
Yes, it's a great question. Keep in mind that one of my areas of expertise here at Kane Waters is that I work predominantly with retirees. And so I am faced with this question every day. And the ultimate answer is the portfolio that we've put together for our clients already has already contemplated a lot of these things. Okay. You use things like you talked about earlier about diversification. But it's so much more than just that. It's really understanding and stress testing your portfolios to know how much of that upside are you going to get versus how much of that downside are you going to get. I tell my retired clients or my clients that are soon to retire, it doesn't matter what age you are. If you're 55, 58, 62, 72, 82, you're going to live through another recession. On average, recessions happen every 7 years. I do this little mental gymnastics thing with my client. I was born in 1971, so I'm 53. And going from 1973, when I was 2, forward, a recession has happened literally every 7 years. And you can do the math on it. And so if we're sitting here and the last recession we had was 2022, and it was a big one, then we're probably going to be due for another one around 28 or 29. And that's just the business cycle. It literally is going to happen every so often. So we build portfolios for our existing clients that can weather those downturns. And that's really the key. It's the downside participation that you can avoid. Let me ask you this, Greg. I have a real simple math. They said there would be no math today, but I'm going to give you a real simple
now
math.
You're killing me here.
All right. If you have $1 million.
Hang on. I got a drink first.
All right. Hey, yeah. That's a good idea.
All right. Shoot it.
All right. If you have $1 million and you lose 50% of your money, how much do you have?
I lose 50% of $1 million.
Yeah. How much do you
I
have?
500,000.
Perfect. Next year, you make 50%. How much do you have?
750.
Correct. Think about that. You lose 50% and you make 50%, and you're nowhere near back to where you started. And so part of the portfolio construction methodology that you should be looking for is how much of that downside can we protect against? Right. Because it's not necessarily, hey, the market's up 20 and you only made 18, you guys stink. It really has to do with the market's down 20 and we only lost 8 or whatever. Pick your number for your risk tolerance.
Right. So we can get into, and I do want to play more in a number of these areas.
Sure.
But for everybody listening, bottom line it for me. You're in the market, going into the market. What are the baseline recommendations? I mean, is it hold, make sure you're diversified? Is it continue to buy? Is it sell, move out of small cap, high risk, international?
Sure.
Right? Just in general.
Yeah. So let's just start with you need to have a diversified portfolio, meaning you need to have exposure to a lot of different things, a lot of different asset classes. So you need to have some cash for emergencies to make sure that you can pay the bills if something bad happens. You need to have some fixed income. Fixed income or bonds moves very, very differently than stocks. And in points in time other than 2022, in points in time when the stock market is down, the bond market typically is not. So you want to have some fixed income to dampen that volatility. Then you want to have stocks, as Jeremy Siegel, famed author, once said, stocks for the long run. You want to have stocks that help to outpace inflation and give you the growth you need to have your money compound like we talked about earlier. Okay. So that's a real simplistic thing. Now you want to get more specific. You want to have not just stocks, but you want to have stocks that sometimes have a lot of growth. The real popular things that have happened here in the last almost decade has been the 7 stocks called the Magnificent Seven. We technically don't have a whole lot of exposure to them for valuation reasons, but you want to have companies that grow quickly. You want to have companies that are stable and have dividends and pay you a yield. And you want to have companies that are big, small, domestic, international. And so you really want to have a lot of different asset classes because they move differently over time. There's a math problem behind that talks about this thing called variance and covariance, and I don't want to give your audience too much tired head here. Right. But just because one moves one way and one moves another doesn't mean they offset each other, because collectively together they move in the same direction. And so you end up getting the benefit of diversification by having less downside and more upside.
Yeah. And so as an example of that, we were talking earlier about the shift in international stocks, in international funds. Right. Can you just enlighten people about that a little bit?
Sure, yeah. International companies have outpaced domestic companies for the first time in a very, very long time.
Yeah.
And so this year, it has paid off to have international exposure. And so, yeah, that's, to me, I think you can't predict those things when they're going to happen before they happen.
Hence the diversification, right? It's,
correct.
Who would have guessed that with everything happening in the U.S., right, and the election and the shift in policies, that international would have exploded.
Right.
And exploded might be a strong term, but
no, it really isn't. I mean, you've seen some international companies or countries like Germany be up double digit already this year. So yeah, it's really interesting to see it happen. The funny thing is when Trump got reelected to president, the stock market took off. And it did really well. And typically the outlook is this guy's going to cut taxes for everyone. Well, that's going to lead to more spending and more earnings in companies. This guy's going to be very favorable to the economy. But then what happened was the Fed chair came out in the middle of December and started saying, well, hold on a second. He's also talking about these tariffs. And he's talking about what that could, tariffs, what they can do to the economy is they could create higher prices, and we've been struggling trying to get inflation down, and we kind of hit this floor at 3%, and we really want to get to 2%, and we can't get there. So with this guy, I don't think we're going to cut rates the rest of 25, and that's what they said in the middle of December, and the market hated it because the market had already priced in cuts that it thought was going to happen, and because of that, you saw a tremendous amount of volatility.
Okay, so let's shift gears for just a second.
Sure.
And talk about, because there are a lot of Seattle Study Club members and directors who are clients of Kane Waters. There are a lot of people working with other
and thank you for that, by the way.
Yeah. No, and we love you guys, and we know you love our folks because they're challenging but a little different, and in a good way.
In a good way.
Talk to me about the Kane Waters difference a little bit. Why?
Sure.
Why do so many of our folks work with you guys?
Yeah, I appreciate the question. I would, I'm biased as anyone here. I'm one of 12 of the owners around here. So, I would say that when you look at what makes Kane Waters different is we have the breadth and the depth of the dental industry first, and we start there. Our roots are in dentistry. And, our founder and my partner, Daryl Kane, I owe a lot to But Daryl started this firm literally with 4 friends that were all dentists, and those 4
Right.
told 4, and those 4 told 4 more, and now we have 3,250 clients nationally. So dentistry first is really part of that answer. I think the other answer from my perspective is we bring to the table the expertise to do so many other things than our competitors. Not only can we look at your dental practice and help you with your business, help you with your cash flow, we do, practice consulting to some extent. We do cash flow management. We do tax projections and tax management. We're CPAs, a bunch of bean counters.
Yep.
And we do investments. And then my specialty is in distribution planning, helping those guys who have climbed the mountain and have gotten to that point to where they're ready to plant their flag and retire, to help them figure out how to come down the mountain and live off that money. So there's, estate planning, the list goes on and on and on. But there's 10 different things that we do where most of our competitors do 1 or 2 things.
Right.
And we're able to address for our clients anything that has a dollar sign in their life and help them. I have, we talked about a car earlier. I have clients that literally call me. They have millions of dollars saved, but they'll call me and say, I had this happen yesterday. How do I buy this car? Should I finance it? Should I pay cash for it? The financing is 5.9% for 5 years, but 3.9% for 3 years. What should I do? And so any question that has a dollar sign to it, we can help you with.
So what do you do?
For this particular client,
Yeah.
he's already retired. He has X million dollars in the bank, and he's a little close on his distribution rate. So I told him he needs to finance this thing and watch his cash flow. So it's very, very personalized.
But yeah, and that's the beauty of it. So let's talk about the business side, right? We started with financial because of the economy and everything going on, but at the core, you guys are business consultants as well, right? Whether that's CPA, practice management, etc. So what are you seeing recently, trend-wise, from a business perspective? Collections, production, right? What trends are you seeing?
Yeah, and the beautiful thing about dentistry is that it is, to some extent, it is agnostic to the economic environment.
Yeah.
And people still go to the dentist. People still need this service. And so the business is very durable. And it's also a big barrier to entry. In order to be a dentist, you have to go to a lot of school. You have to get licensed. You have to be licensed in the state in which you practice. There's a lot of barriers to entry that protect business owners that are dentists versus somebody who wants to go open a car wash. And so it is a very...
Some dentists have opened a car wash. So.
I have several. But it's a very protected industry. And the beautiful thing that I love about working with dentists, and I'd say this regardless of who the audience is here, is that it's a very unique situation. I get asked all the time, why don't you work with this group of people or this group of people? Why dentists? And I will pick on the Seattle Study Club as a prime example. You guys get together and learn from each other. Yeah. Think about what that means. You get together with your competitors, so to speak.
It's true.
And learn from each other to make all of you better.
Yes.
And then you seek out that advice, and you're willing to admit, even though you're highly trained, specialized people, you're willing to admit that you don't know everything. And those things that you don't know, you seek advice on. I love that. That's why the marriage works so well with Kane Waters.
I agree totally. And I had this conversation the other day with a prospective director saying, so you're saying I can get a bunch of it was a surgeon who was looking to do it with a referral base, but they compete with each other. And I said, look, there's more than enough dentistry to go around. And if they're helping each other get better,
right,
everybody wins in that scenario. And
I got 30 some odd teeth here. It's okay. I think everybody does. We're good.
And at the end of the day, most importantly, the patients win in that scenario. If better dentistry is being delivered, comprehensive dentistry, and quite honestly, and I know it's going to sound woo-woo, but I don't mean it this way, what you guys do contributes to that. Because if I'm a clinician and have less stress in my life, because I'm not worried about the financials. Kane Waters has helped me sort through these things. Now I can focus on the clinical dentistry. I can focus on taking care of my patients, and I'm not worried about collections, production, meeting payroll. What does retirement look like?
Right.
Should I take that trip to Scotland or whatever it is, right?
Yes, you should.
Yeah.
Yeah, it's a beautiful thing to work with someone and give them peace. Our kind of our tagline here that we actually had painted on our wall in our old office was that we provide financial peace and security. And if you really break down what that means and you're able to give someone financial peace, man, that's a big stressor for a lot of people in their lives. And if we can help take that off the plate for you, that's why I do what I do. I hope you can tell, Greg, I freaking love what I do.
Yeah. No, I can't tell. I can't. I wish you would be a little more enthusiastic.
I'm trying.
All right, so I'm going to put you on the spot here. What
Good.
haven't I asked you that I should? Financial, economic. What haven't I asked you that I should?
Yeah, I think you touched on it, and we veered away from it a little bit. Was kind of the outlook, where we see the world headed. I tell all of my clients, you said earlier, no one has a crystal ball. I actually do. It's just not clear. My crystal ball is as clear as anyone's.
Can I borrow it?
Yeah. It has a big 8 on it, and you just shake it and you turn it around.
I got one of those.
See?
Got one of those.
You have one then. So, but based on that, I will tell you, the only thing constant when you're looking forward is change. And just remember that. You're going to be in a situation like we are right now where in literally an hour and a half, the president's going to come out and talk about tariffs, okay? And from that, there's going to be uncertainty. And there's going to be volatility and upset. That's not permanent. That's a temporary circumstance that you're in. Understand that leading into even the election last year, we have an economy that's very strong. We have come off of an incredible recession from 2022 where the stock market was down 25%.
Right.
The bond market was down 20% in the same year. That's the largest single year decline in the history of the bond market ever. But we're at a point now to where earnings are strong. Valuations are reasonable and coming down. We don't have PE ratios that are in the 30s and 40s and 50s now. There are some. But we have much more reasonable price earnings ratios. So you're not overpaying for stocks. My outlook is very optimistic. I think that we have a situation where we're trying to have more control over the spending that our government's doing. We're trying to have a lower tax environment. We're trying to have a focus on America first, on, and again, this is not a political statement at all.
No,
it's just that's
not.
where the economics are going. And you have these major companies who are moving their production and manufacturing groups back into the borders of the United States now. That's a huge win. You have multi-billion-dollar investments happening right now back in our country that weren't happening before. And I think that can be nothing but positive looking forward. That being said, it's a bumpy road. It's not going to be smooth. And you will, just like I tell every one of my retirees, you will live through multiple recessions. And everyone feels like it's the end, and it's not. So just understand that you need a long-term focus. And I hate when people say that because in the long term, we're all dead. But when you think about this, you need to think more than just month to month, quarter to quarter, year to year. You need to think about where am I going to be in 10 years, 20 years? Where do I want my pile to be? How does my money grow to get to that point? It's much more than just what's going on right now.
So it's an interesting point, and here is my personal question for you that I think people may not be thinking about but live every day. Do you have any advice for people to help remind themselves to continue to think long term? Because we're bombarded by the short term, right? Whatever news station you watch, whatever podcast you listen to, whatever you're exposed to, it's about what's happening to me today. And it drives all of us psychologically to that component.
Yeah, I think the biggest value that we as an organization add to any of our clients and to hopefully to beyond our clients is that we take the emotion out of investing. I will tell you, Greg, you and I have met. We've met twice face to face and 3 or 4 times over email.
Yep.
And I will tell you that if you were my client, I would care incredibly deeply about you, but I will never care more about your money than you do. And because of that, you are just doomed to make emotional decisions about your own finances. And I think the best thing that anyone can do is find someone that they can trust that can help them to make unemotional decisions about their money. I will tell you that I'm very much the outlier. I'm weird on this. I'm weird in a lot of ways, but I'm really weird in this way.
I've learned that about you.
I'm unemotional about my money. I'm unemotional about it. Being unemotional about money allows you to look longer term because you think about a system now. If someone has a 401k or a defined benefit plan set up and they're systematically saving every paycheck or every month, you don't care if the market's up or down. If the market's up and you're saving every month, you're buying fewer expensive shares. If the market's down and you're saving every month, you're buying a lot more cheaper shares.
Yep.
So it takes the emotion out of it by just having a system.
So I imagine you get those phone calls pretty frequently.
No, never have. Yes, daily. And that's okay. You know, that's my role for my clients is to help. I want them to feel heard. I want to hear the emotion. And then I want to talk to them about why you don't act on that. And you know, our role, as I see it, is to help people understand what their different options are, A, B, or C, and then to say, hey, you know what? Option B is the best financial answer. But guess what, Greg? Not everybody chooses option B because sometimes one of the better emotional answers works better for me long term. And I'll give an example. My wife is a CPA. She's infinitely smarter than me. She's fantastic about our monthly books and records and all that stuff, but she hates investments. And she does not really care to worry about our portfolio. She doesn't want to take a lot of risk. And so when I start wanting to do things like invest in private equity or something like that, she's like, no, we're not going to do that. Even if it's the best answer from a diversification standpoint or the best financial answer, her answer was, no, I want to pay off our house before we do any of that. Well, man, that's like nails on a chalkboard to me. I was like, no, I don't want to pay off the house. You kidding me? It's cheap interest rates. What are we doing? But for us, the best emotional answer was before we get to option B, we need to do option A first to make sure that if mama ain't happy, ain't nobody happy.
Yep. So it becomes a balance of those two.
Absolutely, yep. It does. Yes, there is no one right answer for everyone or for each individual person. So,
okay. So one more question for you, and that is, in the past, at least at Symposium in particular, Kane Waters has offered to do an analysis for any Seattle Study Club member complimentary, meaning look at their finances, talk to them about what you can do for them, what they should be thinking about in general. Is that something that a Seattle Study Club member could just reach out to you or to someone at Kane Waters and say, hey, we heard the podcast. Greg said it was free. Will you guys do this for me?
Sure, and I think ultimately the answer is yes, comma.
Okay.
It is depends on the level of analysis that you're looking for to as an entry point. You know, we have a process where anyone who is interested in our services can call my partner, Charles Loretto, at New Client Services, and most of the people that are listening to this podcast have either know Charles personally or have heard that name.
Yep. If I need to find Charles at a meeting, I just look up.
You just look up. It's the best looking silver haired guy in the room. That's him. So our New Client Services team, you know, part of what we do is we spend a lot of time up front understanding what someone's thinking they need and explaining kind of what our scope of services are, what we do, what we don't do. And in those initial conversations, a lot of that pre-analysis that you're talking about is done as part of our normal process.
Okay.
So, yes, absolutely. And I will tell you that if someone is seriously contemplating, thinking, hey, do I need help in navigating these waters right now? Man, reach out to us. I will tell you that we will do everything in the world to add value to not only Seattle Study Club, but the dental industry as a whole.
That's fantastic. Brian, I appreciate you spending a few minutes with me today. I think this is going to be hugely valuable for our network and for the people that listen to this. And I want to give you one more cheers. Thank you
Cheers, buddy.
for everything. I really appreciate it.
It's my pleasure. It is a pleasure to get to know you, and thank you very much for allowing us to be a part of this podcast.
Very good.